So it turns out that we may very well be witnessing the start of a bear market in 2023. In reality, because of the slowing inflation, it was recently revealed that more than a third of small firms couldn't afford to cover their entire rent in October. 50% of workers anticipate job losses, and the Federal Reserve would likely raise interest rates again in 3 weeks. I'd like to add my own perspective to the discussion given all that is happening, including the rising rates, record consumer debt, and dropping home sales, because it turns out that there is a historically successful approach to invest if you want to make money in a market much like this. In an attempt to break down the possibility of seeing another drop, let's discuss what's happening, the preventative measures you can take in advance to earn as much money as possible, and that we could start to see a fantastic buying opportunity coming shortly to a market near you. As a result, it's crucial to know what kind of downturn we might experience in order to be ready for what's to come. Contrary to popular belief, there are significant differences between how to respond to a recession, a depression, and a complete stock market crash. So let's start by discussing the elusive recession. Even while this is simply defined as 2 consecutive quarters of dropping GDP, a closer examination reveals that it affects much more than just the headlines of CNBC, and is shockingly much more frequent than you might assume. After all, there have been 18 recessions since the 1940s, with the greatest lasting 18 months, and the shortest lasting roughly 2 months during the government shutdown. Since 1900, the average recession has lasted around 10 months, typically with unfavorable repercussions. For instance, the Economic Policy Institute discovered that during recessions, our economy tends to completely decline, starting with number 1, job losses. Companies will look to cut costs as they expect lower earnings, and this normally starts with firing staff to lower overhead. According to a 2009 study, the average worker saw a 6 to 7% income loss for every 1 percentage point increase in the unemployment rate. And even after 15 years, the loss is still 2.5%. This is the second reason why we frequently observe dropping wages. Thirdly, private investment tends to be lower. Just as corporations cut back, people also tend to make smaller, safer investments, which in turn results in future economic development and innovation being lower. However, there is good news, or I guess terrible news, depending on how you look at it, when it comes to producing money during a recession. There isn't much of a relationship between a recession and the stock market on its own. In reality, from 1869 to 2018, there were a total of 16 recessions with positive stock market returns. And during those times, the market rose by an average of 9.8%, while the GDP shrank by 3%. Basically speaking, out of 30 recessions, half had absolutely no association with stock values. But when the market does decline, we observe an average drop of 29.2%, making it very clear that we're on the same track and wondering how much worse it may go. These are the reductions that, generally speaking, you should be kept informed of whenever it comes to building wealth. The first is what is referred to as a stock market correction, which is characterized by a price decline of at least 10%. Since 1920, the S&P 500 has had 3 5% pullbacks on average per year, making regular market volatility very common. Random variations occur constantly. This is also somewhat true of market corrections, which occur around every 16 months and typically last 71.6 days with a 15.6% decline. A pullback as part of a regular economic cycle is completely natural and indicative of a healthy market. After that, we go on to a more serious condition, that is a bear market, and that is where we are now. A bear market is defined as a decline of at least 20%. The evidence indicates that this occurs around every 7 to 10 years, and when it does so severely. In a bear market, stock prices typically decline by more than 33% over a 363-day period. However, the worst-case scenario for how terrible things might go after that is a stock market crash. In the past 120 years, this has only happened 3 times, which I would estimate to be a decrease of at least 40% or more across the entire market. A serious stock market crash is rare, but not impossible. And if Jamie Dimon is right, it might be closer than we think. Of course, 2020 came very close to that, but the FED intervened, and here we are today. It's crucial that you can use this knowledge to your advantage in order to profit, and in order to do so, you must first identify the investors that stand to lose the most money. To begin with, if you want to maximize your chances of earning as much money as you can over the coming years, you must work hard to maintain your current employment. The truth is that when consumers have less money to spend, they spend less. When businesses see a drop in demand, they start to cut back, and employees are typically the first to go. In fact, a quick search on Google for mass layoffs will turn up dozens and dozens of businesses that are starting to reduce their workforce. And as Bank of America warns, the U.S. economy will soon begin losing 175,000 jobs per month. As a result, the biggest financial losses might very well come from others who are unemployed and are unable to sustain their income to continue investing in the market. So over the coming year, keeping your job should be your top priority. If you don't maintain a 3 to 6 month emergency fund, you're more likely to suffer losses in the second scenario. You won't need to use credit cards to get through an unforeseen disaster if you have this kind of emergency reserve. If something were to happen, you wouldn't have to sell your stocks or investments at a time when their value was likely declining, nor would you have to take on high-interest debt. For myself, I've been utilizing a combination of short-term 3 to 6 month stocks or bonds yielding approximately 4 to 4.3% and high-yield savings accounts paying between 2.5 and 3.75% so that no matter what happens, I'm making something on my unspendable money as well as something to fall back on.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
Third, investors who stop buying when the market is down tend to perform statistically worse than those who do. Nevertheless, studies have shown that the typical investor only just manages to exceed inflation with a 20-year annualized return of only 2.9%. I'm not even joking when I say that the vast majority of investors adhere to the philosophy of buying high and selling low. This is perfectly illustrated by the Magellan Fund. The most well-known mutual fund in the world saw record-breaking growth from 1977 to 1990 while being managed by Peter Lynch. The typical investor reportedly lost money under Peter Lynch's leadership during a period when the fund returned about 29% annually, despite the fact that they had outperformed the market by a wide margin for more than 15 years. The reason is that during those years, health experienced periods of massive growth and catastrophic losses, so that when investors only bought during the hype and only sold once they had lost money, they stuck in their losses and missed out on all of the ensuing growth had they simply done nothing in health. Therefore, now that you are aware of the pitfalls, focus on the methods that, according to statistics, will help you generate the most money. If you could follow a few simple instructions, you would be that much closer to becoming wealthy during a recession. First, it's crucial to understand that there will always be an excuse not to invest when it involves building wealth. Like in 2011, when I first began buying real estate, the market had already declined by 50%. And only a few years before, I was purchasing houses for 20% of their appraised worth. But I was advised to hold off because shadow inventory was about to enter the market and things would get much worse. As it turns out, the shadow inventory never materialized, and I'm so pleased I disregarded the advice to hold off. There were many articles about how the market might be headed for a crash or how it was overvalued when I started creating videos on YouTube about investing in the S&P 500. But I maintained dollar cost averaging on a daily basis, and again, I'm pleased I did. It's best to disregard it and continue investing, since as long as you invest, nothing will ever be perfect and there will always be a reason why the market could crash. When it comes down to it, investing is boring, and it's not meant to be fun. I hate to say it, but it's not a game. The majority of people don't expect investing to be this fun, and it's not a sign of a healthy market when individuals are attempting to bet their life savings to purchase a Tesla model for less than the following week. I know it sounds strange to say because for me, investing is an incredible delight. The boundary between properly calculated risk and gambling has regrettably become utterly blurred in recent years, and you must keep this in mind if you want to succeed in beating the markets. Because of item 3, overconfidence, your portfolio will be destroyed. According to what I have seen, the moment you believe you have the market under control and have it all figured out is the time you lose. It is therefore best to understand that the less you know, the better you'll probably do, as you won't overcomplicate things. For instance, every single study has demonstrated that the optimal strategy is to simply use the dollar cost averaging method, invest in an index fund, and do nothing for 20 years. What's more, practically nobody does it since it's so unbearably dull. Therefore, even though you may have friends who earn 5 times as much as you do in the upcoming weeks, or even years over 20 years, I can assure you that they will regret it if they don't adopt a simple plan of action. Fourth, let's face it, any market decline is likely to be worse than you anticipate. For example, you may spot a decline and decide to purchase the dip, but as the decline continues, you may decide to buy more. This process continues until you run out of money, at which point the decline intensifies. Typically, the market bottom will happen when all investors lose hope and believe the market is condemned to failure and will never recover. In 2009, and I'm sure in 2001, this was the situation. Every generation will have those moments that appear out of nowhere and make you wonder if staying invested is a smart choice. It's crucial to understand that things can and will get worse than what you anticipate. I believe this year has been a really significant wake-up call that diversification is better than concentration, and that speculation is not an indicator of a healthy market. Fifth, excellent financial practices ought to be followed in both prosperous and unprofitable markets. Despite the fact that this is an excellent time to work some more hours, cut back on unnecessary expenses, sharpen your talents, and start a side business. Ideally, regardless of how the stock or real estate markets are doing, you should constantly be doing this and making the most out of your time. This is why I've always tried to live frugally, save carefully, and be aware that nothing lasts forever. Those practices will save you 10 times over in times like these. Sixth, it was discovered that 34% of the market's best days came in the first 2 months of a bull market, before it became obvious that a bull market had begun, and that half of the S&P 500's finest days during the past 20 years occurred during a bear market. This is crucial because if you simply missed the top 10 trading days of the previous 5 years, your return would have fallen from 15 to 3.75%, especially when the best trading days follow the worst. As a result, even after all of that has been said, there is still some good news to look forward to. If history is any guide, by the time the recession is over, the market simply recovers and posts an average profit of 1.7% with an average return of 15.3% the next year. This suggests that investing during a recession is one of the most profitable times to do so. Not to mention that the market recovered completely in the 3 years that followed every single recession we have ever experienced. Not to mention, since 1950, only 16 times has the S&P 500's market closed lower at year's end. This means that if you invest everything in the S&P 500 at the start of the year and wait, you have a 79% chance of gaining money. The same is true for real estate. However, long-term values tend to rise and drawdowns often only last a few years before recovering. Short-term prices may vary based on interest rates, supply, and demand. Because of this, it's crucial to maintain employment and continue earning income rather than sell all of your possessions quickly or make foolish investments.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.